What's up, guys? Welcome back to Financial Firefly. My name is Fernando, and today we're going to go over an M1 Finance dividend portfolio update. We just recently hit the $10,000 milestone for my M1 Finance dividend growth portfolio. We're going to go over some reallocations that I recently did and some news on Tesla. They just ran up 11% in Monday's trading day on August 18th. Huge day for Tesla. A lot of big news coming out of that company, and it really shows in the stock price. So let's just get started here. Hey guys, don't forget to start your investing journey by claiming your 2 free stocks from Webull, one of which could be valued up to $1,400 when you deposit $100 or more, possibly 1 free share of Apple, Microsoft, or Facebook when you sign up with Robinhood, and your $10 when you sign up and deposit with M1 Finance. Comment down below to tell me what you get, links in the description. Let's get back to it. Welcome to my M1 Finance passive income dividend growth portfolio. In this portfolio, we take dividend-paying companies, which are excess profits paid out to shareholders for owning part of the company, and we reinvest those dividends back in to purchase more shares of the companies that we have. So I started this portfolio back in December of 2019. Last year, it's been a little over 8 months, and I reached this goal a little bit earlier than expected. This was the goal till the end of the year. I've invested a net cash flow of $8,475, and I've grown a time average return of 40%, or $1,700, which is, I think, pretty outstanding, especially because I'm almost at $100, $97 in earned dividends in only 8 months. It would take a very long time to get there through your traditional high interest savings account, which really doesn't exist with today's low rate from the Fed. So I've been in this portfolio around 8 months now, and I really started it kind of willy-nilly. Joseph Carlson was a good inspiration, and I found out some other YouTubers and people were using it, so you know what, I decided to give it a shot, and I kind of just bought everything under the sun and the kitchen sink, which I thought was a good investment. I had my baseline things to look for. So I was looking for high yielding companies, very, very high yields, high dividends. I wanted some growth potential, which the combination of the two is pretty much a golden goose. That would be like Apple or Microsoft, but they're a little expensive and hard to find, and there aren't many of them. So I bought a lot of high yield, but as you know, illness 19 took over the world, and high yield kind of just fell to the wayside. They really didn't have any cash flow to speak of to pay out. So some of these companies stopped paying their dividends, or they reduced them, or it wasn't a good time for high yield. On top of which, illness 19 pulled ahead innovation substantially by, depending on what industry you're in, years. It really pulled ahead investment for years. And so recently I did a massive portfolio reallocation this past weekend where I essentially got out of most of my high yields, the rest of it, if not all of it, and I put it back into tech and innovation and a lot in Tesla. I am super, super long, super, super bullish on Tesla, as many people are these days, and I just love them. I've always loved them. I can't wait to get one. Can't afford it yet, but I'll get there eventually, hopefully with this strategy paying off. So let's just dive into this portfolio here and go over the allocations. So I have 30% of ARK Invest ETFs. This is Cathie Wood's Disruptive Innovation Exchange Traded Fund. This is 30% of my portfolio, and it's broken up into 5 ETFs. So it's tracking the genomic revolution, the innovation revolution, financial revolution, the web revolution, and the industrial revolution. So these are all, there are a bunch of technology platforms that are coming into play today that really it's the convergence of these reducing cost curves that are really going to change the industrial landscape as we know it, with things that just weren't possible before now becoming possible from a cost basis and a technological standpoint. And that's really what ARK Invest is tracking. They're on the forefront of disruptive innovation. Next, we have Tesla. Enough said about Tesla, but Tesla is Elon Musk's baby. He wasn't the founder, but he is CEO. And this is, I think, the best company on earth right now. The company is endlessly innovating. And they're just at the forefront of so many converging technologies through AI, potentially blockchain. You have electric driving and EVs, and then you have batteries. And batteries, which I think is the big opportunity here, at least initially, once AI and their neural networks are trained, batteries are really going to totally overhaul our energy infrastructure. It just makes sense. And as the battery energy density increases, they're going to be able to influence and penetrate and disrupt more markets. So it's starting out with cars, relatively big in size, then maybe personal transportation solutions, then maybe public transportation solutions, such as buses and hopefully eventually planes, trains, and ships even. And Tesla is really on the forefront of that. The global battery production is super constrained, and Tesla is building 3 factories that are going to solve that issue, or at least help that problem. Moving on, we'll talk more about Tesla in a bit. They had that huge run up today. But moving on, we have technology. In this pie, I have Tesla as another major holding of this pie, Nvidia, which is a dividend paying chip company, Amazon, Microsoft, and Apple, our golden gooses, Facebook, does not pay a dividend, but is a growth company, Virgin Galactic, space tourism. I cannot wait to invest into SpaceX and Starlink and Blue Origin potentially. But the only one of these that's public right now is Virgin Galactic. And then finally, we have Alphabet and Google, the same thing. I should have mentioned earlier that the way M1 works is that you do your allocations by percentagizing, if that's a word, the pies for what you want. And so as you can see here, I have my allocations set on the side, and they're visually represented to the left here. And they'll tell you if it's overweight or underweight for your allocations. And I'm pretty much on par due to the morning trading window taking place. Next, we have our finance pie. I used to own a lot of JP Morgan and Visa for this, but I decided to go more heavily into growth and tech. So in here, it's only 3% of my overall portfolio. But we have a lot of the banks plays, a lot of the traditional bank plays, JP Morgan, Visa, Bank of America, American Express, Morgan Stanley, Royal Bank. And then we have some more innovation, non-traditional plays like Lemonade, PayPal, and Square. I think Square is really doing a great job with Jack Dorsey as the CEO. And he's really making a dent in the financial innovation market, which is tracked by ARK Innovation's FinTech ETF that I mentioned earlier. Backing out, we go back into real estate now. I only have 2 holdings here. Gaming, leisure, and pleasure properties. Huge dividend payout. Really good company. I don't know too much about them, but they've been like the majority of my dividend payouts this year. And Realty Income Corp. I just bought into these this morning, and I'm already up a little bit. The market is pretty down still for real estate and high yield dividend paying companies. So I expect a nice rebound for these going forward. And the same can be said for the bank stocks in the finance sector that hasn't really fully recovered yet. I'm buying them about 3/4 of their high. So in addition to the dividends that they will be paying out, which they currently still are, I will have capital gains associated with that, hopefully increasing my holdings there. Next, we have our consumer. Consumer is Beyond Meat, Procter & Gamble, Johnson & Johnson, AT&T, Abivi, Walmart, Clorox, Home Depot, Lululemon, Verizon, and Nike. And I try to really buy products that I use, that I see other people using every day. And that's really a good indicator when you're looking for an investment is what are consumers using? What are people buying into? And it really gets you thinking, well, if I see it, it must be a good buy. And it must be becoming more ubiquitous, which is exactly what you want. You want it to gain market share. You want companies to increase in market cap and grow organically through word of mouth, not necessarily too much advertising because that's ad spent. Those are dollars down the drain. That's eroding earnings. You really want organic growth. And with all these companies, they're pretty much organic. They're products that we use every day. Clorox, for instance, Burt's Bees. When I found out that they owned Burt's Bees, that was the reason to buy into them because I love Burt's Bees. I use it for everything. Lululemon, I think they're a really high quality company. Really good product. A little high on the price point, but that's good. You want that premium market there, access to the premium market. And then Verizon, obviously, telecommunications, along with AT&T, those two are the top telecommunication plays in the States. And then Nike. Same thing with Lululemon, high quality product, a little bit high end price point, loyal customer base. That's another thing you want to look for an investment. You want a loyal customer base, and that will bring recurring revenue with almost $0 ad spend. And that's something really good to look for. Backing out one more time to the final pie and the newest entry, cannabis. So the cannabis sector has taken a huge hit this year. It's really underperformed the market for where people thought it was going to be. But I really think that's because of oversaturation and lagging legislation. This should sort itself out in the coming years and months. It's really gaining some traction in the House and the Senate to legalize marijuana on a federal level, which will super charge the cannabis industry. There still might need to be some consolidation to go on. But if we go into this pie, it's really broken out by the performance. So I own all of these in my Robinhood portfolio, but ARE is really the best play in cannabis right now, followed by Canopy Growth, Kronos Group, an ETF, Alternative Harvest, tracking the overall cannabis industry, and Tilray. These are all, in my opinion, very good buys at this price point. They aren't as profitable as they hope to be, as every company does, but I think they're really discounted for the potential here. I highly would look into cannabis now while it's kind of on the meh trend, not so much on the downtrend anymore. It's kind of just trading sideways for the time being and waiting out the legislation and the consolidations, like I said. So we'll see. We'll see what happens, but it's a nice little play in my M1. And that's only accounts for 1%. So if we really go to the total overarching methodology behind my portfolio, I am very bullish on tech. ARK Invest and Tesla make up half my portfolio, followed by technology. I forgot to mention renewable energy here, which obviously renewable energy, wind, solar, potentially geothermal, wave energy, all of the sort are in these holdings. Very good buys. The energy sector has a long room to run into renewables, and it's really still just in its infancy. So buying now over the next 10 years, renewables are going to shoot up, and Tesla's going to be a really big part of that with their solar roof. So jumping back to the methodology and innovation as a whole, right? So we have ARK Invest and Tesla being 50%. We have technology, another 10%, renewable energy, 10%, Microsoft, Apple, additional 10% each, followed by 3% finance, 3% real estate, 3% consumer, and 1% cannabis. And really these four pies down here, these four slices, are to provide some stability in my portfolio. Tech and innovation really tends to be highly volatile and unpredictable, whereas consumer goods, that's a very stable sector. Same thing with real estate and same thing with finance. So it's providing some stability for my portfolio while providing some dividend growth potential. And then I have my technology plays for growth, my main technology thesis on Tesla, followed by the golden geese of Microsoft and Apple, where there's high potential for growth, yet they still pay out dividends. And there's no question why they're worth both the $2 trillion market cap companies on Earth right now. And Tesla, while only sitting at roughly $300 billion only, I foresee by the end of next year, if not mid 2022, that Tesla will also be a $1 trillion company, almost hands down. There's so much hype, there's so much going on behind the scenes here that there's really no reason for Tesla not to continue to take off. And that is my main thesis. So I'm thanking you for joining me on my M1 Finance dividend growth tour and my $10,000 milestone today. We may dip down again once Tesla kind of comes back to reality for this point in time. We shall see. But then again, there's no reason why Tesla can't continue to keep running up. We shall see. I hope you enjoyed this video. Be sure to like, subscribe, hit the notification bell to get all the notifications when I upload my video, and catch you later, Fireflies.